Today I have the opportunity to talk to the CIO of Camissa Asset Management, and they also manage a part of our portfolios, especially on the local equity side. So it was always Kagiso Asset Management, and now the change to Camissa. What does that mean, the word Camissa?
So Camissa is actually the oldest name for Cape Town, which is where we're based, and it means place of sweet waters. So it refers to the streams that come down from Table Mountain that are particularly good quality water, and was the old Khoi people that used that name for Cape Town.
Camissa. No, that's a beautiful name. But it's not, in the retail space, it's quite difficult. I know you're still a big company, or manages 46 billion rand. So you are a big company, but it's not in the retail market that well known. Is that a struggle, or where would you say is your advantage in that?
So I think it's a struggle to get people to invest with a brand that's not advertising in the airports and on TV. But I think the advantage for us and advantage for our clients is that we have a lot of breadth of opportunity in the markets. So we have the ability to have smaller investments that are listed on the JSE be reasonably big parts of our portfolio, big positions, which just mathematically is impossible for much of the large managers who own most of the market share in the market. So we can have a 3, 4, 5% position in quite a small company, which can really make a difference to returns, and that just adds to our ability, our arsenal of opportunities relative to our large competition. So I think it's a little bit of an unfair playing field for us on the investment side, but on the branding side, we have got marketing budgets that are not nearly the size of the large guys.
Yeah, no, but that's also why we use you guys, because if you want to go something like the index, you can just buy the index. So if you want to invest money in quality, you want to have opportunities that no one else see, and you can access that opportunities.
Yeah, so I think mathematically when large managers invest, they are confined to 20 or 25 of the largest shares. And then when financial advisors blend large managers, you're basically recreating an index fund. You can do the numbers and compare it to JSE indices, and that's just a mathematical fact. And the reality is that we can take opportunities that are much, much smaller outside of the top 20, top 40, top 50. And typically through a cycle, a large part of our portfolio, over 50% of our portfolio sits outside of the top 50 shares. And the other obvious thing to say about that is when a share is very weak, when prices are very low, the share gets very small. And often that's when the best, really, really big performance opportunities present themselves. So I think that's a huge advantage to us on SA equities.
Yeah, and I know you look longer term, and I think if you see your track record, there can be some of those months that go very bad, but in the long run, your fund do very well. You can look at it 10 years, 20 years, and you can see it do very well. But the last 6 months, and we're in the middle of 2022, wasn't great, and a lot of investors are spooked by that, especially in risky asset classes like equities. So would you say maybe there's more to come, or is that a difficult thing to say, or you don't know?
Yeah, I think we're seeing a lot of opportunity in the SA equities that we own. I think that it has been a time that, in particular, very expensive overseas shares have come down a lot. And we've had some big pullbacks in some of the local shares, like our Process pullback and then has jumped up. I think it's a time of a lot of change and a time of uncertainty with interest rates rising, and I think that you've got a situation where most investment professionals with a sort of 10, 12-year career have never seen interest rates rise. Literally, the ECB in Europe hasn't raised interest rates since 2011. They've just raised them for the first time. So most people have never seen this environment where interest rates rise, and I think pricing in various markets have got very frothy, and I think it's just an unwinding of that. So I don't think that means that all equities are going to be poor investments in the years ahead. I think there's some fantastic opportunities that we have in our portfolio, so we're pretty excited about what's coming.
But especially on the local side, you get big interest rates, like you said. So a lot of people say, why do I have to take risk in equities? Because I can get, without taking any risk, put it into bonds or cash. So what would your recommendation, or would you say to something like that?
So I think in the long term, it's pretty obvious over almost any long period, 5, 10 years periods, throughout history that equities vastly outperform alternatives. I mean, they are riskier, they're more volatile, and they can take more benefit from more opportunities within sort of the economic growth environment, and are somewhat inflation protective. So if inflation rates go up, like they have been, equities generally through the long term have outperformed inflation, whereas alternatives just don't. So I think that's the main thing, is I think just historically equities, because of the volatility that they exhibit and because of the nature of the risk that they present, especially in the short term, in the longer term, they are vastly superior investments.
I think the last 7 years, equities underperformed, I think, to historical averages, like the index and the whole. So then the next 7 years is probably a reversion to the mean, hopefully. But a lot of people will say, yeah, well, but South Africa is going down the drain, so I don't want to invest my money in South Africa, I want to take everything offshore. What would you recommend, or what would you say to that?
So I'd say that there are two basic decisions that one's looking at there. In one's personal finances, if you want actual dollars versus a rand-based investment, that's a different thing, where you've actually got your money physically offshore and it's not domiciled locally. And I think that it makes sense to have a portion of your wealth invested directly overseas in dollar assets with nothing to do with South Africa. So I think that there's some sort of South Africa risk mitigation that comes from that. But just on a pure investment returns point of view, ignoring that issue, I think that the first thing I'd say is that the JSE contains a vast number, in fact over half of by market cap or by earnings, over half of the market has got nothing to do with South Africa. So if South Africa is weak, or South Africa's prospects are poor, which I think they are, those assets have nothing to do with those poor prospects. And they are, let's say, a Richemont, which sells luxury goods, jewelry and watches all over the world, particularly in China, or a Process, which is mostly invested in Tencent, which is a Chinese internet business, or BAT, which is tobacco and cigarettes and new generation products right around the world, and so on. And the miners that are marketing their metals that they produce or their minerals that they produce to global markets. So all of those companies got nothing to do with South Africa and the prospects of poor economic outlooks in South Africa. So that's the one thing I'd say. So just investing in the JSE, one can do really, really well. And in particular, if the rand weakens. If the rand weakens, many of those shares go up. It's a strange anomaly. In really tough times, the JSE often goes up in rand terms. But the other thing I'd say is that in tough times, really good management teams and really good companies can take market share and grow and really do well. And you've got an environment where potentially the really superior companies can do exceptionally well, whereas the very poor companies fall over and give up market shares so that the good companies can prosper. And I think we've also got that feature in South Africa. So for example, if you think about the retail market, 10 or 15 years ago, Edgar's and Edcon were massive. It was the biggest clothing retailer, and it's essentially fallen over and shared market share for 10, 15 years to the benefit of all the other clothing retailers. I think in the banking side, Capitec is running rings around the large competition and growing hugely and doing really, really well in our environment. So a company like Mr. Price has benefited hugely from Edgar's demise, or more recently, Takealot is benefiting hugely from Massmart and Game and Macro's problems and troubles. So I think one of the things that happens in a tough environment is the strong get stronger and the weak fall over. And I think the benefit, or the challenge for us, is to try and identify those that are very weak and not to be invested in them, even though they might present very low PEs or screen very well on so-called value screens, and actually lean much more to higher quality businesses. So, I mean, an example in our portfolios would be Sanlam. So I think Sanlam is a vastly superior insurer, financial services player, wealth manager, than many of the competition in South Africa. So I think they will continue to gain market share and do well, and to the the detriment of some of the other competitors.
Yeah, and rather than just to buy the index, you would say, okay, don't want all the companies, I want some of them.
Yeah.
I don't want all the other competition.
Yeah, so that's the problem with an index-based approach, is you get everything. And you would have got Edgar's, although it was taken private, but you would have got the equivalent that sheds market share for years. So I think that is the benefit of being able to stock pick, is especially in a tough environment. I think it's very, very important.
Yeah, and talking about stock picking, I remember a presentation a few years back. You got a lot of flack for not holding Steinhoff, because I think that was like the beautiful, everyone wanted that share because it gives you that offshore exposure and it just keeps growing. So why didn't you invest in Steinhoff?
Yeah.
And now in hindsight it looks brilliant, but in that time, remember, it's very difficult.
Yeah, so I think the reality is that what we do in our approach is to take a very deep look at what's going on in the company and to look at their strategy, to look at what they disclose, to try and understand what's going on. Very deep due diligence is really what we're trying to do. And we were very uncomfortable with a wide array of things that they were doing, and never could get our minds around what they actually were doing, what they actually were delivering, and why they were doing what they were doing. So I'll give you a couple of examples. So for example, they continuously changed their disclosure. So you were never able from one year to the next to be able to go back and say, okay, this is how they disclosed it last year, and this is what it is this year.
So you actually read the financial statements.
Yeah. So you actually look but it's not just looking at it, because every time they give you a pro forma of what the past would have looked like, but it's always to suit themselves. So it always changed. You could never just by looking at the financial statements for the last 5 years see what the progression was, because it just changed every time. So that's a flag. Not a sort of a reason to avoid it, but that's a big flag. Then the other one was that they would change their strategy all the time. I mean, they would have a strategy to be a European discount retailer, and then all of a sudden, overnight, they bought a massive mattress company in the US, which is a jurisdiction they'd never talked about before. And then they paid double the share price where it was trading the previous day, which just screams out that something's wrong here, and that they're trying to get bigger for getting big's sake. So there must be something wrong in one of the smaller divisions, that they're just trying to get bigger and bigger and make that problem smaller and smaller in what they are, and they don't care what they pay to get bigger. And then they came back and bought Pep in South Africa. They were getting out of South Africa, and they came and bought Pep. And so all of a sudden they changed strategy from being a European to America and European to back to South Africa, and that didn't add up, and a variety of other things didn't add up. And the other detailed due diligence question that didn't add up for us was the cash balance. It just never seemed to be able to generate cash. And strangely enough, in the final event, the final fraud was actually on the cash line. So they had the cash and cash equivalents line, and the fraud happened in inflating that and making it look like they were delivering a lot of cash flow, but actually they were falsifying debtors in some subsidiaries in Europe and calling them cash equivalents, but putting it together in one line. So yeah, there were a variety of red flags, or a variety of things that didn't smell right, and essentially the investment case came down to a charismatic CEO who you just had to believe. And time and time, even when he changed his story, even when he changed his story, and actually it's a powerful lesson for investors to really be careful of very charismatic CEOs that people just believe in. I mean, the EOH was a very similar situation. It was very hard to see what was going on with EOH. Disclosure was terrible, their strategy didn't make sense, and they had this charismatic guy at the top who you just had to believe. African Bank perhaps also similar, the charismatic guy at the top who A, people don't say no to, but B, has got so much power, and whatever he says, investors believe. So,
do you think there's going to happen anything with Steinhoff or you think it's just going to carry on like this? Because a lot of people believe and want to buy again.
Look, Steinhoff is a shell company. You've got to take a special situations view now of the litigation that they have, the settlements that they're potentially going to have, and maybe additional lawsuits. So the class actions, additional lawsuits. And ultimately the prospects of what the businesses are. It's very small what the nub is. So you've still got lots of debt, lots of lawsuits, and a small equity value, what's left, the residual. it may be a good opportunity, but it's very small now. And it's very hard to form a view on things like litigation and that sort of thing.
So
and
just stay away.
Yeah, we're staying away from it. Yeah.
If there's one stock pick that one stock that you will buy for your children or for your grandchildren, what would that be? Or the portfolio you know you're going to keep for the rest of 20 years? I know 20 years may be a long time.
Yeah, so I think that at the moment I would say Prosus at current prices. I think it's a company that is obviously a direct link into Tencent, which is an amazing Hong Kong listed company that predominantly works in China or operates in China. And I think we're getting into Prosus at the moment when it is deeply unpopular. So the discount to the underlying assets is pretty high. And you're also getting into Tencent at a time when sentiment towards Tencent is very, very weak and low. They've just come through a period of all sorts of negative things that have happened to them, which I think by investors' nature being human beings, what happens is people look at what's happening now and they think it's going to continue happening for the next 10 years, 20 years.
Bias.
Yeah, recency and availability bias, what's available right now. And I think that in Tencent, you've got exposure to one of the fastest growing consumer markets on earth. Because while China's GDP growth is slowing down, the composition between the investment side of the economy and the consumer part is changing. And consumer incomes are growing very, very fast. And we've got a very, very powerful platform business in Tencent with a wide variety of exposures. But just one that I think is mind-boggling is that they've got 500 million active users, 500 million people using their mobile phone portal. So it's something we don't have in the West. And in the US, they're dying to get, the various companies are dying to try and engineer it. But if you can imagine in the good old days of the internet, you had this portal and you went in there and you did everything from it. So this is a portal that you go into on your phone. You only go through one app. And you order your Uber, you order your food, you book your parking bay, you do everything that you do on your phone normally. You check the weather, you check the news. Everything happens within Tencent's app on the phone. And you do your banking, you do your purchasing, you do all sorts of things. And the list is just growing and growing and growing. It's called Moments, Weixin Moments. Sorry, it's called mini programs, where other companies host their apps effectively in Tencent's app. And I think it's an extremely powerful thing if they just get a little bit of the value of each of those activities and they keep their ecosystem, their people together in a network. And that's just by way of one simple example with 500 million people using that very actively. And it's seen as the holy grail in the US or elsewhere, and nobody has cracked that. Some people think that, for example, an Uber they've got your credit card details, you do taxi, and you could do, do food, you might do other things, and eventually you could be doing all sorts of things on Uber. Or maybe it's Apple iTunes or something, or it's unlikely to be Facebook or Twitter or something like that where you don't really trust it. And you don't trust it. So I think that sort of thing is extremely, extremely powerful. So we've got access to a very fast-growing consumer base with an incredible technologically enabled service product that has great economics, very high margins, very low marginal cost, and an ability to follow trends of how people are using their leisure time in terms of playing games or watching videos or listening to music. I mean, they've got the Spotify, they've got the Netflix, they've got all sorts of equivalents all within Tencent. So yeah, I think that would be the one that and you're getting it at a very, very low price now. So that's one I'd be very positive on for 20 years.
Thanks, Gavin, and thanks for your time. And we continue to keep invested with you guys. I think the performance speaks for itself. Maybe you're not in the airports, but the performance speaks for itself, and that's why you still have a lot of money.
Yeah, so I think when we are investing in advertising in the airports, I think it's perhaps a warning sign that we've got too big and we're just trying to keep our clients rather than grow.
No, thanks.